As already mentioned in an earlier session on retail credit risk is the failure of a borrower to meet his loan repayment obligations on the due date, giving rise to deterioration in the quality of the assets and consequent potential losses to the lending institution. In this and the next few sessions, we will look at measuring and managing credit risk pertaining to corporate borrowers, where the loan sizes are large and the tenor of the loans are long duration as well. We will look at it from four aspects, four very time-tested methods. One, credit appraisal to proactively evaluate the credit risk profile of the potential borrower. Two, pricing the credit risk, that is, determining the interest rate on the loan based on the credit risk profile of the potential borrower. Three, monitoring the performance of the loan on a continuous basis to assess changes in the credit risk profile of the borrower during the life of the loan. And four, provision against potential default by borrowers on their repayment obligations on the loan. Later, we will look at a series of credit risk models which would help predict or quantify the credit risk and hence the likely losses from potential default by borrowers. First, credit appraisal. Credit appraisal involves a careful scrutiny and analysis of the prospective borrowers covering the following: ownership and management. Evaluating the ownership pattern, that is, whether the company is closely held or widely held. If closely held, assessing the pedigree and profile of the promoters, that is, the major shareholders, as well as the performance record of the top management of the firm, both past and present. Two, operating efficiency. Operating efficiency of the firm measured in terms of its growth trajectory, market share, and operating profits. Three, financial efficiency. Financial efficiency includes the current financial leverage of the firm, that is, the debt equity ratio of the firm, the ability of the firm to raise long-term funds, its cost of capital, its resilience in managing working capital, etc. Industry-specific or market-specific factors. These include the business or industry cycle, such as recession, inflation, or deflation in the economy, that could obviously impact some industry sectors more than others. For example, borrowers in the steel and automobile sector could be more seriously impacted by a recession than borrowers in the pharma or FMCG sector. Remember, the pharma and FMCG sector are fundamentally more resilient to recession and such other macroeconomic factors because the demand for their products would exist irrespective of whether the economy is in recession or not. Macroeconomic factors such as inflation and high interest rates. When interest rates in a country rises, firms with a high level of debt are more likely to default on their loan repayment obligations. Changes in the regulatory environment, which could increase cost of compliance, hence reduce operating profit, and consequently the probability of default by borrowers. Threat from substitutes to the company's products and potential shift in consumer demand that could reduce sales, increase inventories, and therefore hurt the firm's ability to repay the loan. A comprehensive analysis of the above four factors, namely ownership and management, operating efficiency, financial efficiency, and industry-specific or market-specific factors, should enable the prospective lender to make a good qualitative assessment of the credit risk profile of the prospective borrower.